Hi, I'm Amber Rose Crowley, and today I'm going to present the dark side of the Black-Scholes model, because some people have theorized that the Black-Scholes model actually caused significant share market crashes since its inception in the 70s. So I'm going to go over what exactly the Black-Scholes model is, some recent share market events and the causes of each, concentrating mostly on Black Monday in 1987. And I'm also going to give some conclusions and recommendations from my research into the Black-Scholes model use. So Fisher, Black and Myron Scholes published a paper in 1973 outlining a method of determining the value of financial derivative instruments. So prior to this time, there was no real accurate way of determining the value of derivative securities or derivative instruments, and so the use of options was somewhat limited. So I'll go over the assumptions that they used in finding a solution. I'll go over the derivation of the model, present the partial differential equation that constitutes the model they used, and give a solution whereby they've found the value of a European call option using known terms. So the assumptions that Black and Scholes used were that markets were perfect, that there was a known constant interest rate, that the share price followed a log normal random walk, there were no dividends on the share, although the model can be modified to include dividend effects, that there were no transaction costs involved in buying the derivative interests or derivative instruments or the shares, that they also had no issues with borrowing securities. So Black and Scholes started off with a portfolio of delta amount of shares and one short derivative instrument. And using Ito's lemma, they found the change in value of that portfolio in one time step. There was a problem with this equation in that it contains a stochastic term, the dx, which is non-deterministic as it's a random sample from a standard normal distribution. However, Black and Scholes realized that if they made dv on dx equal the delta, as in the amount of shares, then the first term in brackets would actually equal 0, and the non-deterministic stochastic term would disappear. And another result of using that equation was that the expected rate of return would be removed from the equation as well. So essentially they had created a riskless portfolio. So using arbitrage arguments and algebraic manipulation, they eventually came up with this partial differential equation, which they then could solve, as it was a boundary value problem using 3 boundary conditions. So the terms in this equation are V, the price of the financial derivative in an underlying asset with share price S, T is the time, sigma is the volatility expressed as a rate, and R is the risk-free interest rate. So yeah, Black and Scholes eventually solved the partial differential equation for a European call option, as shown. So ND1 is the cumulative standard normal distribution function, and ND2 is the same, where the endpoint of the integration is either D1 or D2. So now I'll go over some of the events involved in recent share market crashes. So for those, for Black Monday, the dot-com bubble, and the financial crisis. So during the 80s, there was a very high-performing share market. It was continuously growing at a rate that people could not comprehend, as in they were making so much money. Then the Dow Jones reached a record high in August of 1987 of 2,722. Then on the 16th of October, the Dow Jones actually dropped, the largest drop it had done in history. But that was going to be surpassed on the 19th of October, Black Monday, when it fell 508 days in a single day. 508 points in a single day. However, on the 20th of October, crisis was averted when the market rebounded. Then we have the dot-com bubble. So there was a rapid growth in the technology sector during the late 1990s as people were using the internet more and more and the capability of the internet increased. As a result, there was a lot of investment in IT companies by venture capitalists and also through IPOs. Then on the 10th of March in 2000, the NASDAQ reached its peak of 5,000. But by the mid to late 2000, people began to realize that technology companies were overspending their venture capital and it could not be maintained. So share prices began to fall. Then in 2001, many technology companies actually filed for bankruptcy. And NASDAQ companies lost more than $5 trillion over the time period 2000 to 2002. Then we had the financial crisis. So some of the lead up to the financial crisis was the dot-com bubble causing the US government to actually incentivize the banks lending money to consumers. And so this led to an increase in housing prices as more and more people were buying houses and supply was beginning to fizzle out. Then in June 2006 to June 2007, the repayments that people were paying on their home loans actually began to increase, and homeowners realized that they were unable to meet these repayments and so defaulted on their home loans. Then this began an oversupply of houses, which led to house prices falling. And in the background of all of this, a lot of banks had invested in mortgage-backed securities. And so when people began to default on their loans, they realized these mortgage-backed securities were worthless, and banks and investment companies actually reported massive losses from June 2007 onwards, even with some companies failing, and the US government having to bail out a lot of big banks and investment companies. So now I'll go over some of the factors that caused Black Monday in 1987. So I'll go over the concept of portfolio insurance and also just a little touch on program trading. So portfolio insurance is basically the use of financial derivatives to limit loss when share prices fall. So you can use a protective put to limit your losses, and this involves buying a put and buying a share, the same underlying asset. And as the share price falls, you're limited by the protective put payoff actually stopping the share price falling too far, or the portfolio value falling too far. As when a share price goes down, the value of a put increases. But the use of protective puts was kind of limited as the availability of calls and puts, call and put options was limited. Then in 1981, Rubinstein and Leyland actually hypothesized that you could use stock and cash to create the same portfolio insurance effect. The actual use of this synthetic option was rapidly adopted in the months leading up to Black Monday. So I'll go over what the actual concept is. So if we look at a portfolio of one long call option, we can see that its value follows this black line here. And Rubinstein and Leyland hypothesized that they could create that same value equation when looking at stock price and value by using by buying shares and borrowing money, borrowing cash. So they hypothesized that if at a certain amount in time, if you wanted to have the same value in your portfolio as the option, you could use the slope of the line, the slope of the value of the call, and buy that many shares in a replicating portfolio. And then where that dashed line met the y-axis was where that would determine the amount of cash you would have to borrow in order to replicate the value path of the call option. So if we move across this dashed line, that's where the exercise price of the call is. And so that was where they took the tangent of the call value. And the slope of that line was how many shares to have in the portfolio, and also the amount of cash to borrow was the y-intercept. So the way to synthesize a protective put, we can see, if we look at this table, we could long one share and then long a put to create a portfolio insurance position. But then Rubinstein and Leyland believe they could long the stock and also lend money to create the same effects. Then as the share price rises, they buy stock financed by borrowing, and then as the share price fell, they sell stock and they lend the proceeds. So essentially it was the same sort of technique as a delta hedged portfolio using options. Then throughout the 1980s, there was also the increased use of computers to automate these insurance trading strategies. And as a result, the stability of the share market was compromised as computers could carry out way more trades than people ever could in a short amount of time. And this led to the massive losses on the Dow Jones. Although some other people also hypothesized that this program trading also helped for the market to correct itself. And it was a way of the market showing its efficiency. It's also being said that that portfolio insurance technique was actually unstable, because as share prices fell, you would sell shares, and as share prices rose, you would buy shares, which is only going to make share prices fall further or share prices rise further. So as a consequence of Black Monday in 1987, they have things known as circuit breakers now, where if the share market falls too much in a certain amount of time, then trading is stopped. And nowadays, destabilizing portfolio insurance strategies like the one Rubenstein and Leyland formulated are no longer so accessible or used, really, due to the destabilizing effects. So now I'll just quickly go over some causes of the dot-com boom or bubble and crash. So there was overconfidence, as investment professionals were really pushing technology stocks, believing that they were going to grow and grow and grow. They also had tax policies in the US, which meant that dividends were taxed at a higher rate than capital gains, which incentivized people to buy technology stocks as they were high growth, so low dividend paying. There was also a large amount of IPOs in the 1980s, during the dot-com boom. And the underpricing of IPOs created rapid initial growth, which investors saw and thought was worth putting their money into. The causes of the financial crisis, once again, were overconfidence and also misleading information. So there was this belief in the US that house prices couldn't decline, and they were safe as houses, essentially. And then that mortgage-backed securities were given AAA credit ratings these mortgage-backed securities were packaged with lots and lots of home loans, and some were AAA home loans, but some were subprime, very poor credit ratings on some of them. However, banks were drawn to these investments thinking they were super safe, and then so they were drawn to these mortgage-backed securities, and big investors weren't really, and banks couldn't really bear the risk because they were also lending out the money for the mortgages, and so this led to all of the banks, or a lot of the banks, failing in the US. So can we say that the Black-Scholes model and Black-Scholes are to blame for share market crashes? So the use of derivatives can be helpful in curbing risk, as we showed with a protective put. But you need to understand the assumptions when using a Black-Scholes model for valuing a financial derivative. There are a lot of assumptions in the Black-Scholes model that aren't realistic. So transaction costs, there are always transaction costs associated with portfolio insurance strategies, like the most. So the when portfolio insurance strategies were coming into play in the 80s, they were finding that they couldn't, the cost to buy the insurance on the day when the Dow Jones was falling was actually too much, and that's what led to further falls in the Dow Jones. And so if Black-Scholes were really to blame, why would the model still be used today to value financial derivatives, even though people have stated that there may be a causal role? So from the financial crisis, people have suggested that maybe if people had actually used the opposite derivative to the mortgage-backed securities to add to their portfolios, then they wouldn't have been exposed to that same risk. And a lot of people were speculating buying those mortgage-backed securities, which led to the massive financial crisis in the 2000s. Yeah, so this is my bibliography. Thank you for your time.